What if I told you that one of the most important investment decisions you make has nothing to do with a stock, ETF, or mutual fund you buy? It's deciding what you're going to do before the market crashes, before fear takes over, and before everyone around you starts telling you to sell. That's where an investor policy statement comes in. Today, we're going to break down what an IPS is, why every serious investor should consider having one, and how you can create your very own, even if you're just starting your financial independence journey.
Everyday people working 9 to 5, saving up that money, trying to survive, investing in the future, trying to be wise. We're gonna be money heroes. Yeah.
Hi, I'm Nik Johnson, host of Everyday Money Heroes, and I've reached early retirement. I'm here to provide information on how to obtain financial independence and inspire you through sharing stories of everyday people who are turning knowledge into freedom.
That hustle, always reaching for the sky. We're gonna be money heroes, never gonna shy.
Hello and welcome to Everyday Money Heroes. We provide information and inspiration to people of all ages to take control of their financial journey. I'm your host, Nik Johnson, and today we're going to talk about an investor policy statement. Okay. So what is an investor policy statement? Sometimes referred to an investment policy statement, but it is basically a roadmap that outlines your financial goals, investment strategies, and risk tolerance and rules for managing your portfolio. Because many of us are DIYers, and we're going to really use that as one of the tools that we have in our toolbox. So before we get into that, before we get started, I'm going to ask if you're watching this on YouTube that you would subscribe to Everyday Money Heroes. If you are listening to this episode on your podcast player of choice, that you would follow Everyday Money Heroes there. Okay. Now, with that being said, let's get started. Why do we need an IPS? An IPS is something that you don't always need during the good times, but you definitely need it during the bad times. Okay. And that's why it is so critical. It's almost like a roadmap to how you're going to govern your portfolio, the mix of your investments inside of your portfolio, and certain rules around how you're going to manage it. Okay, so what are the core parts of an IPS? An IPS basically is the why behind your money. It is also outlining the target allocations of your money as far as how you're going to break it down, as far as, okay, you're going to have US equities, international equities, fixed income, real estate. So it allocates those kind of things. The selection and implementation criteria, as far as, okay, what kind of instruments are you going to use? Are you going to identify low cost investment vehicles? Are you going to use bond funds? So it's going to identify that kind of stuff. Also, it's going to outline certain things around portfolio maintenance. When are you going to rebalance? What are you going to do as far as when it comes to contributions? What are you going to do with around tax strategy? So it's all around maintenance of your portfolio and your investments. And one of the most critical things in your IPS is that it gives you guardrails around a bear market. Okay. It provides explicit instructions to your future self on what to do and what not to do when the market drops, 20 to 50%. So this is really, sometimes there's emergency. They say in case of emergency, break glass. Literally, if that was a situation, when you see that market drops 20, 30%, you would have this IPS behind glass and you would take that hammer, you would break it and you would break it out and you would read it. So that's really one of the big things that this IPS would do. Okay. And so those are kind of some of the core parts of an IPS. And your IPS should answer some key questions. And these, I'm going to kind of rattle these off. What's the goal of your money? So it could be, financial independence, early retirement, a house down payment. And let's talk about this. You can have one overarching IPS, or you can have an IPS for every different kind of account that you have. You can have an IPS for your Mercy Fund. You can have an IPS for your financial independence account. You can have an IPS for a vacation fund that you have. So you can have it any way you choose. It really is a flexible tool. So you can have one overarching IPS, or as I said before, you can have them broken down into different accounts. Okay. Also, along with the goal of your money, as far as the purpose of it, also you want to know what your target asset allocation is. So whenever you do our target allocation, whatever percentages we have, we know it needs to equal to 100. So you can have 80% equities, 20% bonds. You can have 100% equities if you want to. It's completely up to you. And this kind of goes back to what I said before. Personal finance is very personal, so you can have it however you choose. Also, it's going to outline how and when you will rebalance your investments. So you might say, okay, I'm going to do it once a year on my birthday. You could do it every December, whenever you want to. You can say that you could rebalance it once you kind of drift outside of your target. So if you have 8% equities, 10% bonds, 10% cash, if you kind of start to drift outside of uh, those percentages, you can say, okay, now this is a triggering event for me to go through and change some things as far as the rebalancing. Okay. Also, it's going to identify how you'll handle new cash flow. That's whether if you're getting your periodic, you know, checks, or if you get bonuses, tax returns. So it's going to say, okay, how am I going to handle this new cash flow? Also, it's going to identify, as I said before, kind of those bear market guardrails. So what is my protocol during a market crash? Is it going to be, okay, I'm going to do nothing, and I'm going to continue to buy on my schedule? I'm going to turn off financial news. Am I going to sit on my hands? So those are really the things that are going to be outlined around what are you going to do during a market crash. Then also it's going to talk about under what specific conditions am I allowed to change this policy. Okay. So typically that's around major life events, might be marriage, birth of a child, retirement, but you never want to modify your IPS during market volatility. You don't want to do that. Okay. Part of this tool is to create it when things are okay and um, you're able to think critically and that you're not acting out of emotion. Okay. So that's the biggest thing. So we talked about some of those kind of guardrails. Also, I made mention earlier as far as who needs one. Every investor should at least consider having an IPS. Typically, if you might have someone like a financial advisor or something like that, they almost act as a buffer between you and the sell button. When you're a DIYer and you're doing it yourself, you don't have that safety switch. So what happens is this IPS is going to act as that safety switch for you. Okay. So what you should do as far as if we think about who should have an IPS, it definitely should be a DIYer or anyone seeking financial independence. Also, this is a good tool for couples. This just makes sure that everyone's aligned. You all would sit down and you would draft this IPS together, saying, okay, these are the goals that we have as far as our financial future. And these are going to be the rules that we've come together to identify that's going to govern our interactions and our transactions when it comes to this portfolio or these investments. And also, anyone who is just starting their FI journey, it is strongly considered that you go ahead and create yourself an IPS. Part of the reason with that is that once you're just starting and you're investing, you're still just kind of establishing your habits when it comes to investing. You're just building a portfolio, you're just getting your cost basis and things like that. And so once you're only, a couple weeks in, a couple months in, maybe even a year in, you might have not seen a drop of, 20 to 30%. And so what happens is that you want to understand that this is just something that happens when you invest in the stock market, when you have those downs. So you're going to say, okay, this is what I'm going to do when the market goes down. I'm going to understand that this is just a feature of the market. And if I have any available funds in which to purchase these equities on sale, I'm going to do so. Just sit on your hands if you're not pressing that buy button. Okay. So really, those are the individuals who should really consider having a IPS. It's great for anyone to have one, but definitely, DIY is really great. Couples is really good, and folks just starting off on their FI journey. So we've kind of talked about the parts of an IPS. Let's kind of go ahead and take a look at one. So I'm going to go ahead and just kind of pull up an example of what we could see in regards to a IPS. So I know some of you might be listening to this by way of podcast. I'll call the parts out, but please feel free to jump over and catch us over on YouTube if you'd like to actually see the way I have it laid out. All right, here you can see this is a very simple IPS that I have here on the screen for you. What you'll notice is that it starts off as far as the date that you're establishing it and the last revised date in your name. Also, you'll see the purpose and objective. Here, the primary objective for this IPS is to build a long-term portfolio to achieve financial independence, capable of supporting a 4% annual withdrawal rate. And we know that as the 4% rule. Here, the time horizon is 15 years or until full FI is achieved. Also, this is the philosophy. I believe market timing and stock picking consistently underperforms low cost, broad market index funds over time. Focus on a high savings rate, broad diversification, and keeping investment fees under 0.1%. Okay, so that's what we have. Here you see an example of a core asset allocation. You'll have U.S. total stock market here in this example, 80%, total international stock market, 15%, and bonds or cash equivalents at 5%. As I mentioned before, it needs to equal to 100%. Here, you're saying, okay, these are your funds of choice. These are the funds that you're going to use. You might use VOO, VTI, VXUS, BND. Or if you don't have access to those, you might look at some Schwab or Fidelity equivalents there. So also, it talks about tax efficiency as well. Here, we're going to go ahead. We're going to look at contributions and rebalancing rules. Here, we're going to DCA, which is dollar cost average, biweekly into accounts, directing new money toward whichever assets class is currently below its target percentage. When we talk about our target percentage, we can see that up in core asset allocation. That's number 2. Okay, so that's the way that goes. Here, they decide to make the rebalancing schedule every December. You can do it whenever you want to. It's completely up to you, but the thing is that you want to make sure that you adhere to it. Here, we just have some rebalancing triggers. Now we're talking about if the class trades more than 5% outside of what we have identified. Rebalancing is done primarily via new contributions or within tax advantage accounts to avoid tax events. And so that's one thing you want to keep in mind. Okay, whenever you want to rebalance, if you're selling, if you don't do it in the right account, it could trigger a taxable event. So we want to make sure that we are making sure that we're rebalancing in the right accounts. Also here, we're talking about emergency funds and cash reserves. We're talking about maintaining 3 to 6 months of basic living expenses in a high yield savings account. The fund sits entirely separate from the investment portfolio and is not subject to rebalancing rules. Some people will use a sweeps account inside of their brokerage account as their emergency fund. Some people choose to have it in a completely separate account so that they're not commingling them. It's completely up to you, as long as you identify that your emergency fund is strictly for emergencies. One of the big things here that we want to talk about is the bear market protocol, the guardrails. So market pullbacks of 10 to 30% are normal and expected occurrences. Action steps during a downturn in the market. Do not sell equity holdings. I've said it before, I said it again. You do not lose money until you sell, okay? And so just keep in mind, it's just paper losses until you actually sell those equities, okay? So just keep that in mind. Second thing here, maintain or increase the standard savings rate. That's just basically saying, hey, if the market falls down, I'm buying them on sale. Also turn off daily account balance tracking and financial news. So sometimes some individuals have set up where, they might have a dashboard to refresh every day. They might have an email that gets sent to them that gives them their current balances. They're like, hey, I don't want to see it at this particular point. I'll just step away from it and I'm gonna just go ahead and just ride it out. Also, continue rebalancing per the 5% drift thresholds. Buy equities while on sell. Okay? So these are kind of some of the guardrails that's in there. This is just an example. You can use whichever guardrails you like, but I think this is a pretty good kind of foundation for a bear market protocol. And then also your condition for document revision. This policy will only be updated upon major life milestones. As I said before, marriage, birth, approaching FI. And so it will never be altered as a reaction to short-term market performance or media narrative. Okay. So this is why your IPS is extremely important. Okay. This is what you need in a situation where things look dire and you don't know what to do. You go back and you look at what your previous self said to you about it. It's because your previous self is telling you that things are going to happen. We've already identified how we're going to conduct business within these accounts and our transactions. So just wanted to share with you really quickly what an IPS is. If you need to, feel free to go back and review the example here of the IPS. It's a very useful tool that you can use when you're setting up uh, your approach for your financial independence journey. So that being said, I'm going to remind you once again to please subscribe to Everyday Money Heroes if you have not on YouTube. Also share this with a friend. Also down in the comments, let me know if you already have an IPS. If not, do you think that you'll create one? And if you think that there's been situations in the past when you didn't have an IPS, if you wish that you had one, and it would have helped you to have some clarity in a market downturn. So with that being said, I'm going to sign off here. I'm your host, Nik Johnson. And as always, I'm going to remind you to trust the process. Have a great day.